In a world of unpredictable markets and constant economic shifts, one question remains. How do you build wealth that works while you sleep? Welcome to What Pros Do, the podcast where we sit down with top real estate investors and financial freedom seekers to uncover the strategies, tools, and mindsets that turn uncertainty into opportunity. This isn't theory. This is what pros do. Let's build a life on cash flow, freedom, and future-proof wealth.
Hey guys, welcome to What Pros Do. I'm super excited to have a special guest today, Hans. Hans is an amazing person because he actually helped me out on my Subject 2 deal. And he's part of the reason I was able to get my Michigan deal over there. And he walked me through the steps on doing it correctly. And I just want to say thank you, Hans, and thank you for jumping onto the show.
Hey, great to be here, Ray. Thanks for having me.
All right. Well, Hans, I think people are very interested in Subject 2, and having someone of your caliber, one, just kind of introduce us into the space and even just tell us what Subject 2 is, right? Could you just kind of give a brief introduction on what you do, a little bit about your backstory? Because I think people would love to hear it. Go ahead, Hans.
Yeah, absolutely. So yeah, I helped Ray close his sub 2 deal in Michigan. Now it's going to be an awesome Airbnb. So really cool to see that you've crushed that, and you're doing such amazing things, man. So it's really cool to see you grow in your real estate endeavor. So what Subject 2 is, I got into Subject 2 real estate investing about, I think, 3.5, maybe 4 years ago. I started learning about it maybe 5 years ago. And this was before Sub 2 became a huge sort of marvel in real estate investing community. There's a lot of hype about Sub 2. I feel like it's died down a little bit kind of recently, but especially when rates went up after crazy low rates of COVID time. Once rates went up, Sub 2 became popular. And so now you see it all over the place. But I still find that most people don't really do Subject 2 anyways. Like, even with all the hype, it's still very few investors actually construct a investing strategy around Subject 2, which is what I did. And so my story is that, well, originally I was a jazz trained musician, and that was kind of my first career. Up into my mid 20s, I went off. I did a PhD. I was really interested in New Testament, early Christianity. I'm a person of faith, but I have an academic lean to me, so I went to go do that. Got a PhD in early Christianity and early Judaism. I taught some courses. I wrote a couple books. And when COVID hit, the job market was terrible. It's when I was supposed to be getting a job, tenure track position somewhere. The job conditions went from terrible to even more terrible with COVID. And so that's when I had a plan B, which was to start building a rental portfolio, start doing some wholesaling to see if I could provide income for my family. And quickly, I cycled through all the different basic strategies of real estate, which was really wholesaling. I did a fair amount of wholesale deals, flipping houses. I did several flips, holding rentals. I had 10 doors at one point. And then there's a few other things. My wife got her license. I was thinking about getting a license, but none of the strategies were fulfilling the reason I went into real estate, which was to generate passive income. Massive passive income is how I put it. Everything was like a lot of work, and don't get me wrong, doing sub 2 deals and doing them the way I do is still a lot of work, but the end result is what I think is the most passive income you can get from a real estate transaction. So basically, sub 2 is just getting really great financing on a real estate deal. I do single family houses. So, I go out and I find a motivated seller who needs to sell, and they are willing to allow me to take over their loan payments, leaving the loan in their name, but selling the house to me so that I can procure really great debt. Like, I'm talking 2s, 3s, 4% range interest rates. which means I've procured great financing, because in real estate, you need a great deal, but you need financing. So you need to find the deal, you need to fund the deal, and then you need to exit the deal. That's 3 pillars of real estate investing. So you find the deal, but you need to fund it. That's where sub 2 comes in. And once you do your first sub 2 deal, it's like, um, the blinders come off and you're like, oh my gosh, funding a deal has never been easier than this. Like, literally, finding the deal and funding the deal, just, they go hand in hand. And now I've done 2/3 of my task. Like, now all I have to do is exit the deal and make money on it, right? So I started to do that about 3.5 years ago, and slowly scaled a portfolio. Now I have about 40 or so deals that I hold in my portfolio, which I purchased almost all subject to, and then sold with seller financing and or lease options, which basically it's a set it and forget it model, where I actually make money on all of my real estate deals every single month. At least most of the time. Of course, you always have people who aren't going to pay, but that's what I do, and that's the vision of my business.
Hans, I think one thing that when I was first getting started in my subject to journey was just how overwhelming it felt. You know what I mean? Like, I understood the concept of, taking over somebody's loan and getting their interest rate, but the act of actually getting it done really intimidated me, right? And I think that's part of the reason I reached out to you. The other thing I want to mention before we hit that topic is, in a high interest market like Washington, right? Trying to find a single family home that cash flows in Washington state is pretty much impossible if you're going the traditional route of conventional financing, right? And I think your strategy really opens up the opportunities that, hey, you can still buy a single family home and cash flow. You're just going to have to use creative financing to make it happen, right? So, for somebody who's getting into subject to, which was me specifically, I notice the hurdles, right? And the big hurdles I kind of want to ask you about is this. It's like, well, one, is it legal? Is it legal to take on somebody's mortgage? And, what are the risks doing that?
Yeah, there are so many hurdles. It feels like when you're wanting to do a first sub 2 deal, but it's once you do one, you kind of realize that was the easiest thing. And you also kind of realize there's nobody out there telling you, well, like, when you're actually doing the transaction, the title company, the seller, anybody else involved, the insurance, nobody's out there being like, you got to do the subject to deal this way. It's like, you just do it, and hopefully you have somebody to guide you through it to make sure you don't mess it up. But yeah, like, it's the same thing. Occasionally I get that objection, like, this isn't legal. Now that it's more common sub 2, like, I don't get that objection as much. But basically, the answer is, usually I don't give it legal advice, almost never, but now I can. Like, if you're in the United States, doing a sub 2 is legal, at least. I know there's some lawsuit thing in Arizona which could potentially jeopardize things, but if you're right, currently it's legal to do. And in fact, what I point people to is the HUD-1 settlement statement, which is the federal government's settlement statement. If it's the standard settlement statement, not everybody uses it, but there's the HUD-1 has a line item for the subject to mortgages that you might be assuming taking over this seller's mortgage payment. But also, and I never hear anybody else talk about this other one, the conventional lending closing disclosures, the CD. If you ever go out and get a loan, your lender issues a CD per the Dodd-Frank requirements. Closing disclosure with all your loan terms and stuff like that. And there's one of the pages, there's a breakdown of all your closing costs, right? Like title fees, recording fees, lender fees, appraisal fee. And then it does like a little settlement statement on one of those pages of the closing disclosure. And if you look down, there's also one of those lines, subject to mortgages. So it's not only on the HUD-1, it's also on the standard closing disclosure. So if it's somebody telling you it's it's illegal, like you just literally hand them a sheet of paper being like, okay, if it's illegal, why is it here and here?
Perfect. And then here's another one, Hans, and this is the one that always scares pretty much most people, and I know it scared me, right? Was the due on sale clause, right? Like, oh, if you do a subject to, you're gonna get a due on sale clause. The bank's gonna go after you, and you're gonna have to pay them all this money of what you owe, right? Could you kind of, what is that? Like exactly, like
Yeah.
why should people be worried about it, or why shouldn't they be worried about it?
Well, I'll tell you one thing. I'll just lead off with this that I've done over 50 sub twos. I hold most of those still, and I never get woken up or lose any sleep about the due on sale clause, and I never even think about it. It takes up almost 0% of my mental space, and I'm a sub two expert. It's like I built my portfolio and will continue to build it on taking over mortgages with the due on sale clause in it, and I literally think about it 0 times. The only time I think about it is when I get asked this kind of question. All right. So hopefully that gives you people a sense of how much of a nothing burger it is. Of course, the note could get called due. Like it is possible. If you do a sub two deal, you are taking a risk and you could lose everything on that deal. So me saying that is going to turn some people off, being like, "Oh, I can't do this." However, I'm a very logical person, and I try and do things from a rational perspective. Statistically, it's if you chart out from like some of the big top players, and right now I'm thinking of one attorney in Texas who does a ton of these. He went through all of his deals and is like, statistically, it's a 0.00001 chance. Like it was somewhere around there. And then there's another Texas attorney. There's a few big ones in Texas that close sub two deals. Uh, he had the same statistics. So then you just kind of blend the statistics, and then you take what I've heard from everybody else who does a lot of these transactions, and basically like, yeah, it's in the let's just call it 0.01% chance range of a due on sale happening. And then there's things you can do to make it even a smaller percentage. And that's why having somebody to guide you through your first one is very important. But yeah, it can happen. If you're sloppy and not detail oriented, don't have the guidance, don't do sub two deals. Just don't do it, because the rest of us out here doing these, we don't need a sloppy Joe guy coming along, messing one up, a bank calling a note due, and then being like, maybe we should call more of these due. Just stay out of it
Yeah.
unless you're going to do it the right way.
Yes. And can I tell you, Hans, when you had taught me how to close my deal, right? You gave me all the steps that I needed to do to protect myself, to ensure that the owners were signing the right disclosure forms, that I had the power of attorneys, you know what I'm saying? So I really felt like you gave me the tools I needed to be able to execute my deal and not be worried about it. And from somebody, taking your course and you guiding me through the steps, this is my personal experience, right? Yeah, was I worried a little bit about the due on sale clause? Yeah, you don't want to pay a full mortgage that you owe, right? So, but after talking to you and going through the process, I felt very comfortable, right? Even when I went to the title company and they were like, "What's all these disclosure forms you're signing?" And I was like, "Don't worry, saying these are the forms I need to make sure that I have what I need for this deal," right?
Yeah.
And I almost was guiding my title company, and they've done subject to transactions, but having you there guiding me through that made it a lot easier, right? So
Thanks.
also, I think the big ones that I kind of want to cover are the things that you told me to look out for to ensure that we don't have issues. One of them being insurances, right? Doing proper insurance. Did you want to kind of go into that just a little bit?
Yeah, definitely. I can break it down really quick and fast. So the background is that it's the number one way for a due on sale to occur is if you have the insurance policy when you purchase the home sub two and you get that new insurance policy. If you do it the wrong way, that's the number one way of triggering a due on sale. Probably ties for not making the mortgage payment, or it might be a close second behind if you don't pay the mortgage. Well, then they're just going to call it due. But user error, number one way is just doing insurance incorrectly. So if you do it now, let me just inject a little story here. Somebody called me yesterday. I helped them do some of the paperwork on a sub-2 deal a couple of years ago, and they called me and they said, "Hey, I have a quick question," and they wanted to close their sub-2 deal in the name of their LLC. And I don't know what we talked about back a couple of years ago. I'm sure I would have advised them to close it in a trust, because that's how I've always done it. But they wanted to close it in an LLC, and I didn't help them. Like, they were only asking for a couple things, so I didn't help them with the entire transaction. I wasn't really consulting for the entire thing. And so they closed it in an LLC, and they didn't do their insurance policy correctly. They did not even list their seller, the person who sold them the house, whose loan they're taking over. They didn't have them on the policy anywhere. Obviously, I didn't help them with the insurance policy, because that was like the number one thing you need to do, right? And he's like, "Hey, I'm trying to file a claim, and the lender's telling me, like, hey, the borrower's nowhere on the insurance." And I was like, "Well, hold on one second here. Let's just get something straight. You've done the sub-2 deal now. It's been 3 years, I think. It's actually 3 years ago that you have not had this note called due. That seller is nowhere on the insurance policy, and that lender hasn't called that note due. That's crazy." Like, this is how, when I tell people statistically unlikely that the due on sale is going to occur, to me, I'm like, bro, you didn't have the seller as an additional insured. That's how you get notes called due. And literally, he had it for like 3 years without it, and they still didn't call it due. Let me give you one other quick story, and then I'll get back to insurance. We closed a deal. We used a mobile notary. The seller had moved away, and the notary, this was a subject-to deal, took all of the documents, all of our disclosures. We're putting it in a trust, and then we're going to deed it over to me, and my LLC will actually own it. We're buying it sub-2. All this paperwork. The notary is supposed to send everything back to the title company after they get the signatures. They sent it to the lender for some reason. Literally, they send it to the lender. Like, "Hey, everybody, we're doing a sub-2 deal. I'm selling the house, and I'm giving this guy is going to be paying my mortgage." And what's crazier is the seller was in the process of doing a loan modification. So we were checking the online portal every other day, like, "Hey, did the loan mod go through? Did the loan mod go through?" And now we have this fiasco on our hands of, like, the lender has all the documents stating we're doing so. So what ended up happening with that is the loan mod went through. We never got any letters, and we just started making the payments, and everything was fine. But like, banks don't. There's a whole thing. If you look into it, you're going to hear, "Oh, banks, they want a higher interest rate." It's not how it works. Once they're borrowing money at a certain rate, they sell the loan, and they make their little markup, their little arbitrage percentage, or their whatever they do. But they're not holding on to these loans. It's the portfolio lenders who are holding on to these loans, who are getting the low interest. So anyways, if it's a big national lender, the chances are so small of the note getting called due. But back to insurance, you want to make sure it's done the right way. You essentially, guys, you just want to make sure that the borrower on the loan is listed as an additional insured. They need to be on there as additional insured. If you can get it on the first page, so that whenever there's a change to the policy, because insurance providers send paperwork all the time. Like, I don't know if you own a house, everybody on here owns a house, you're probably getting like letters from your insurance all the time. "Oh, there's a change to this, there's a change to that." So they're getting hit with these documents from the insurance provider all the time, and they just really need to check a box. Like, so there's some guy working $15 an hour or $20. I don't know what they're making, but they just need to tick a box saying, "Yes, the insurance declarations page has the seller, the borrower, on there somewhere," right? And so, you want to make sure you do it the right way. You're going to hear a lot of different things out there, like, "Oh, keep the seller's old policy and get a second one, pay for two." "Oh, don't do additional insure, do additional interest." "Oh, if it's in a trust, you need this LLC as like there's so many different opinions about insurance. I guarantee you, um, well, there's a lot of people who don't know what they're talking about. There's a lot of people who don't know what they're talking about. So you need to get with somebody who has the confidence, can show you the track record, and that's what I'd say. I just wouldn't feel comfortable trusting anybody on what to do with insurance. But yeah, Ray, we got yours was easy, easy peasy.
And I think I want to share, like, also, guys, like, talking to Hans, he's got a great network, right? And one of the things that Hans was able to help me out is like, hey, Hans, who do I go to get insurance on my property, right? Because that's difficult in its own. Because if you
Yeah.
try to talk to an insurance company who's done subject to, who's familiar with it and knows how to do the paperwork correctly, you mention it to most of them, they don't even know what you're talking about, right?
Great
So
point.
I think, having someone like you, Hans, with the network that you have and being able to connect me with somebody, the whole insurance part of my subject to deal was so simple. Like, I
Yeah.
don't think there was much that I really needed to concern myself with other than getting connected to the person you told me to get connected with. And to this day, I'm still using
Yeah.
that person,
Okay.
and
Awesome.
I'm having I'm having a great experience with it. And I still don't have a due on sale clause on my property. You know what I'm saying? So
That's awesome. That's good to hear. That's good to hear. I'm glad that they're working out well. In fact, I don't use them primarily. Actually, there's somebody local who I get the best rates from, but on a couple of deals we do use them because they either insure where we can't insure, or or they just offered a better premium. And it was like, heck, these folks will go to bat for you if the lender raises any fuss, like, hey, why isn't the borrower on here as the named insured on the policy? They will actually get on the phone with the lender's insurance departments to kind of point out to them, hey, it's in a trust. Here's the seller on the policy. Just move on.
yeah. Hans, another topic that I kind of want to bring up, and let me know, are you still okay on time, Hans?
Good. Yep.
Yeah, okay. Another thing I really think people need to get educated on is, why are most people doing subject to an LLCs and closing it and taking the deed over an LLC, right? And I
Yeah.
remember when I was doing a lot of my personal research, I was seeing people taking it with a trust, right? And I was trying to understand why. And then when I found you, you were the one that was really talking about that in detail. And it made me really interested in your channel because, oh my gosh, like, here's a guy who's really talking about this in detail. And could you dive into that just a little bit?
Sure, absolutely. Yeah, I should give credit, I think, probably in general, but specifically with regard to trust stuff, to my original mentor, Jeff Kaufman. He's here in St. Louis too, and he has got a channel called Sub 2 Empire. I'm Sub 2 Investor. Jeff is a great guy. Really knows his stuff, and Jeff hammered the trust stuff home and really explained it to me in a lot of detail when I was first learning it. And so he's laid a really great foundation for me to then go and see how other people do it, and then determine for myself, this is the way it really needs to be done. Come full circle. Trusts scare people off because it's like, what the hell is a trust? And I'm going to tell you, most people don't know what a trust is. Like, you go talk to some attorneys, most people, they're gonna think you're talking about a living trust that's for like estate stuff, and they're not gonna know what a land trust is. Or a lot of attorneys don't like land trusts, and depends on what state you're in. There could be some laws, so you need to consult your laws or some legal counsel for whatever your state is in. Some stuff about you can't call it a land trust. Um, there's some weird things out there. So I feel like that's right from the get-go. If you're operating in a state where you don't know anybody else using trusts in real estate deals, it's kind of like you have to figure it out for yourself. You're gonna have to do some homework. And so trusts are a little bit cumbersome just to kind of figure out what the heck, how does this work? But I'll tell you how the basic structure of a revocable trust, it's a land trust, and but basically, we can change out the people within the trust. That's why it's called a revocable trust, because we can revoke who's the trustee, who's the beneficiary, as opposed to an irrevocable. The reason why we use trusts in a sub-2 deal in the first place, it's really all a smoke and mirrors game. It's just to give the illusion of that the borrower on the loan is still the property owner. That's the reason why we use trusts. It's a shield against the due on sale. Okay. Now, as I've used trust, I've come to really love trust because there are really cool things, really easy ways to bring in joint venture partners, equity partners, even lenders, and then to convey ownership in ways that are just so much easier. If you have to take a property back, you don't have to do another deed. You can just switch out who the beneficiaries are or the trustees are. Getting down a rabbit trail there, but basically, when the property is in the name of a trust, nobody knows who is the actual owner, who the actual beneficiary of the trust is, and so it's an anonymous vehicle in which to hold title to a property. And it's really easy once you get a template. Maybe you just have an attorney draft one for you, or you get a template somewhere that works for your state, get it reviewed by the attorney state. And once you have a template that works for you, you can just go rinse and repeat on all your real estate deals. You have I have a bunch of different trusts. I mean, I've established over, close to 40, 50 trusts or whatever in my time, and they're all named different things. They're all individual different trusts. And so essentially, I don't know how much detail you want me to get into, but basically the way that it works is this, okay? Your seller is your initial trustee. So that way you get some paper. I know that we might have done your deal differently, and I was in process of trying to figure out what I thought the best way was when we did your deal. But now I've determined it's best to have your seller be the trustee. They immediately resign. You, the buyer, becomes trustee. And the reason you do that is that you have your seller, you have a sheet of paper showing the seller of the property as the trustee, which you can hand to the lender in the event of a due on sale clause to stop the acceleration of the mortgage. The beneficiary can be whoever you want to really own the property, which is usually my LLC. Or if I have an equity partner or a JV partner, we're going to go 50-50. And then we can even write within the trust, here's the breakdown of responsibilities, or you can do an amendment with like a JV partner sort of operating agreement to sort of show what responsibilities go, for each party. So you can get really creative with trusts. And LLCs, you have to file an individual tax return for every LLC you create. Now, trusts don't give you any legal protection, but there is a barrier to find out who owns the property. I mean, an attorney is going to have to find out who is the trustee, but the trustee doesn't actually have the interest in the property. They need to find out who the beneficiary is. So if you have, so basically you're putting up roadblocks for any legal litigation that could come your way. And that's why I like trusts for real estate in general. And your LLC can be the beneficiary and it'll just pass on through to your LLC. But let's say I have 40 different trusts. I don't have to file a tax return for 40 different trusts. If my one LLC is the beneficiary of all those trusts, then I have to file one tax return for my LLC, but I have the anonymity, and it's sort of a indirect liability shield against anybody figuring out that I own these 40 properties. They're going to have to trace down every single trust, subpoena the trustee, subpoena the documents. Well, what if I've had multiple resignations of my trustee occur? They're going to have multiple subpoenas. I mean, basically, it's a genius way if you have the wherewithal and sort of mental space and ability to handle complexity to kind of like just not get sued. So, and it helps you just in terms of the due on sale stuff. So, to me, it's a no-brainer using trusts.
And can I tell you, Hans, from someone who was just kind of learning, right? From how I kind of understood it was a shield. The trust document is not something that's publicly filed, right? So for me, like I have mine in multiple cloud storages. I have it filed away, You know what I'm saying? So in order for somebody to figure out who is actually the owner of that trust, they would have to request that document, right? And that kind of blew my mind, right? Because in reality, like, that information's not out there. So if a bank were to try to figure out who owns the trust that owns this
That's
house,
right. That's right.
well, then they're gonna have to subpoena me. And that right there made me feel so much more confident in closing a subject to deal in that manner, right? And it made sense to me, because if you are going to do a deal like this, you want to take as less risk as possible and do things the right way. And
Right.
and that's how I kind of saw it, and hopefully that kind of helps anybody in the audience kind of understand, because yeah, definitely you went into detail, but I kind of glazed over when you went over those details the first time with me. You know what I mean?
I mean, you're right. I tend to go deep into the weeds right away. The thing I should have said is, look, there's a thing called the Garn-Saint-Germain Act. It was established in the 80s, I think, that says that fact check me, I could be wrong, that lenders cannot foreclose, they cannot call a note due if a borrower quit claims their house out of their name into a trust. Like, it's literally a federal regulation that lenders could get, sued for by federal prosecutors if they start calling notes due, because they were doing this. By the way, that when the interest rates were really high, I guess there was some history of that, and so the federal regulators came in and they said you cannot call a note due just because a borrower is putting it into the name of a trust, right? Because they're still the beneficiary owners, or they're the interested party in the property. Like, they still have the equitable ownership in the property, even though it's in a trust. Garn-Saint-Germain. Lenders know this. They know. So when they see that the property is in a trust, all they need is Garn-Saint-Germain to tell them, you can't call that note due. In fact, they're taking a legal risk. Think about that. If they mess up, right, and they get it wrong, and what if that borrower actually was the trustee, right? What if so let's just say you did the sub two deal, they were the trustee, they resigned, I became the trustee, bank calls it due, I resign, put it back into their name as the trustee. Now they are in violation of Garn-Saint-Germain. Guess who's not happy about that? Federal prosecutors. Does the bank want to mess around with that? No. So I'm telling you, use a trust. Garn-Saint-Germain doesn't protect against due on sale because they are transferring their beneficial ownership. So technically, the trust doesn't protect you, but it's just all the illusion and the fear and the what if this, what if that, that effectively it gives you a near bulletproof protection against due on sale.
And I want to add to that, Hans. I think people should think about, you're going to have to get into trusts down the future if you're getting into investing. If you're going to look at asset protection, if you're
Right.
going to look down at maybe giving it to your kids, you don't want them to go through probate, right? So it's better for you as an investor to understand how to use trust now and get learning on it. And I'm starting to see the advantages, right? I could sell properties and change the owners inside my trust without ever actually, you know what I'm saying? You could
Exactly
probably
right.
you can go more into detail with that, but like, I think these are the specific things. But guys, what I want you guys to know is this: there's a lot that goes into subject to to just assume that you can just walk into the deal and do it yourself without any kind of mentorship. I'm sure you can with all the information, but I think it's really helpful to have someone like Hans who can give you the tools you need. And it's been a great experience for me. I'm not here to just like promote Hans, but I just want to just be honest in my experience. And you're really, truly the reason why I was able to close my deal, Hans. And I really appreciate that. Another thing I want to say is, you can tell that Hans has all this wealth of information, and there's so much, I would say, misinformation in the subject to the community. And I just want to say how I appreciate how you kind of give that information out, and you don't really sugarcoat it, right? And you just give it for what it is. And that's something I appreciate about Hans. And if you just compare it to what's out there, it's just really nice contrast. So thank you again, Hans, for doing that.
Thanks, man. I appreciate it. I agree. I hate it when people sugarcoat stuff. I just, would rather have them shoot it to me straight, because at the end of the day, I want to get down to business and I want to get stuff done. So I don't need to go through a bunch of phony baloney before I figure out, oh man, this doesn't really work, or this is kind of not worth it or something. I don't know. So there's enough of that out there. But yeah, my academic background, but then my creative background too, I guess, just kind of gives me this somewhat of a unique perspective of like, I can really explain it down to the bare bones for you, almost to the point where it's like, I wouldn't say it loses its luster after a while, because I'm like, guys, this is not hard. Just listen and do this. You'll be fine.
All right, Hans. The last thing I want to ask is, I know you have a YouTube channel. I know a lot of people are going to be interested in getting to talk with you and ask you some questions. What's the best way for them to reach you?
Yeah, absolutely. So, like you mentioned, my YouTube channel is sub2 investor, like sub the number 2 investor. So you can type that into YouTube and check out some of my videos. A lot of people like how I break down actual deals that I've done, show them in extreme detail how they actually work and what goes into them, the numbers and whatnot. But then, yeah, you can reach out to me at hans@sub2investor.com if you want to connect.
Perfect. And guys, definitely follow his YouTube channel. Definitely, Hans is one of my mentors, and I really appreciate your time. Guys, thanks for tuning in to another What Pros Do episode. And thanks again, Hans, for jumping onto the show.
So much, Ray, man. Great hanging with you.